It's a VC panel. We're going to challenge the role of VCs and the future of VCs in this industry. Inviting the glorious speakers who made it here today despite heavy traffic. Alex from YZ Labs, former Binance Labs. Alex, please join. Gary from Further Ventures, all the way from Abu Dhabi. Rodney from Hack VC. And Zurab from BeatScale. Thank you guys for joining. It was a heavy morning, heavy traffic. It was difficult to get here, but we all made it. So please join us for a very challenging panel. This is going to be a bit of an unusual VC panel. You have seen many VC panels, and usually investors talk about what are the trends and how the market is doing and equity versus tokens and all the other things. This panel is going to be very different because we're going to challenge the very role of venture capital in the crypto ecosystem. Yes, it's happening. And anybody who is following crypto Twitter knows that this subject is very much up lately. There's a big debate whether it's justified, not justified, and how investments should be done in this industry. And this is what we're going to ask our esteemed investors today. So let's look a little bit into the history of things. So when in the period of ICOs, VCs were contributing big amounts, but also retail was participating. As you know, ICOs were all risk ventures, right? So basically, in today's world, the way things are done for traditional finance, regulator is there to protect the little investors, right? So in this case, the big VCs were taking the big risk and little investors were getting less share. So is this the right way to continue, or crypto, because it's slightly different than other industries and it was meant to remove the intermediary, should be open for retail? That's the question that we're going to try to answer today. So I want to kick it off with the big word, the fair lunch. What fair lunch to me means to each one of you. So I don't know who wants to start. Rodney, you're holding mic. I don't know if you're feeling comfortable to kick it off. What do you think about fair lunch? Like, where does it find you?
Yeah, sure. So these are all my personal opinions because Hack is a SEC registered fund. Yeah, I mean, fair lunch, you could, there's a lot of, uncertainty around that structure over the past few years. Hard to say where the best jurisdiction, legally and all that stuff looks like for these sorts of launches, but it exists, lots of projects do this sort of thing. I think it's great. I think every project has the opportunity to fair launch. There's no mandate to certainly go raise from VCs or anything like that. That's actually way harder than fair launching in some ways. So yeah, always an option. We love fair launches.
What do you think are the shortcomings, if any? What comes to mind?
Well, how often do you hear about fair launches these days? I think a big part of it is awareness and community. A lot of it is about retail not being as comfortable as VCs to underwrite, investments into open source software, or maybe not having the capital to do so, or being unable to organize the capital to do so. Yeah, but diligence for VC deals is certainly a full-time and operationally intense system. So I can totally see why retail might be more hesitant to go out there and price deals. But we've seen new platforms come out we have Echo, we have Legion, a bunch of these sorts of things. And yeah, I think a lot of projects are seeing more value in onboarding the community. But again, the projects that are raising on these seem to be mostly VC-backed projects as well. So hard to say. It does feel like, people like to look at VC diligence or, trust VC opinions in the space.
Right, thank you. Gary, where does it find you as a sovereign fund?
Well, I don't buy that there's kind of this general tension. Twitter loves VC drama, just because Twitter loves drama in general. But at the end of the day, well-run venture capital firms are there to support questions like what jurisdictions should we launch in, because there's usually someone that is in charge of regulatory affairs. right? There is, a team that's there to functionally support the launch. Now, there's a lot of tourism in venture capital, right? We had a lot of, non kind of venture design capital and participants come into the space during the ZERP era. And yeah, you have a bunch of folks that have followings that will launch, project on Echo, and I don't know if any of those, investors ever make their money back, right? And so there's a lot of, investing that happens in crypto, but I wouldn't qualify it as traditional venture capital, right? And so, you have to be, I think there's this weird disintermediation that if you're receiving money from an investor and you're early, it's venture. Well, no, if you are receiving money from a well-run firm that seeks to support you over a multi-year journey, then you're raising money from venture capital. Otherwise, you're just, playing with fire.
Interesting. Alex, you have a special position here. YZ, former Binance Labs, you have a huge stake of everything that is happening. So, your thoughts?
I want to follow on this. I actually think that's very much the case. So, we're talking about fundraising as if it's just a sort of exercise of receiving capital, money, which is obviously the case. But I guess what you're not getting if you do a fair launch is some of the value add that some investors have, and there are really good investors, really good funds. Lots of, actually they built a lot of the kind of best practices that we have, how you should think about, building a team, setting up the right kind of regulatory aspect, not to have this, regulatory risk overhang, how you should think about token launches and so on. All of that you don't really get with a fair launch. However, I do think fair launches, they have a very specific, unique place in crypto because they've actually, they started as part of being very core to crypto ethos. So this whole idea about decentralization and having a fair level playing field for everyone to participate is very dear and very close to everyone who started in crypto early on. And that was the case with ICOs. Of course, they were very much abused, but there were a lot of successful ICOs that have created a lot of wealth for all of the participants that took part in it. There were a lot that didn't and went to zero, but I think fair launches are an important part of crypto culture, and I think they have a very good place for projects that can navigate all of the other things. So perhaps if you're building maybe a second or a third project, you already know all of the best practices, and you're very well placed as a team to actually do it all on your own. Maybe that's a good thing to explore.
Thank you. Zarab, your turn.
Thank you. Yeah, actually, as a VC, I should probably hate fair launches, but usually I actually love it as a person who's been in crypto for quite some time. It's kind of utopian approach when you feel like the distribution is also very decentralized and it's launched in a fair way based on the contribution community have been doing, either providing liquidity or some other incentives in many ways. But the case is that fair launch really does not fit all of the projects. For example, if you're building heavy infrastructure company, you will very likely need initial capital to bootstrap, network effect, to do audits, to help with development, because it's mostly very resource heavy, and it's impossible for some of the projects to launch properly without proper financing. There are some examples. I would say if you're a founder, if you have enough capacity and resources to do things yourself, you're confident you can launch, you have already got some kind of recognition in the space, and you think you're able to launch yourself, I think it's also a very good way to go for it. Of course, I'm totally for it, but sometimes it's just feels like it's necessary to get funding before launch. And getting back to those companies that were mentioned, like Echo and Legion, I think those companies are amazing. I participated myself in some of those sales in Legion, but I don't feel like it's part of the fair launch. I would say it's a hybrid model. So me as a VC, I registered on Legion. I got like top 1% based on my on-chain score, and I was able to participate in the same projects. And they like the way Legion works is they do scoring. So based on who you are, what's your on-chain score, you're able to get allocation. So I think it's hybrid model, which is I think great, and there is a lot of future around it.
Thank you. Well, I personally find Legion over KYC, if I may. But thank you very much for great insights. And I think the message to the audience is, be reasonable. Back to crypto Twitter. Be reasonable about how you want to do it. All right, next difficult questions. Are you ready? Vesting. Vesting terms, please. Who wants to start? Gary is ready.
You know, what I find really funny about, our industry is that we kind of got started in this, we're anarchists, we are creating this new financial system. And it turns out there's like a lot of really great ideas in finance that are meant to protect people from scammers and that are meant to protect investors from churn within founding teams. There's a very good reason that it is completely standard to have reverse vesting in every US venture-backed company. And it's not because the investors are looking to disintermediate the entrepreneurs. It's because sometimes people leave and they have kids and they move to another country and they don't want to be part of that team anymore. And then that value needs to be recaptured back by the enterprise. And so now we have everything from Magna to all of these other tool sets that are available to us to do token investing, and we're not even close. I think we need much stronger mechanisms in order to get parity to the kind of governance that a kind of well-run normal finance company should. But we're getting there. It's been great to see improvements there. And you see, again, the absolute best top-performing teams in the space typically wait to launch a token, right? They typically prove the function of what they're trying to build. And there is some controls that their community or investors have. And that's, again, these are normal things.
Well, anyone here had the bear chain? No? No. Oh, yes, okay. I mean, you want to do first, or we let Alex tackle? Yeah, you want to do
I
it?
thought you were smoky for a while.
Yeah, vesting, always a funny term, I guess just thinking about it, there's a lot of things that are interesting to consider vesting-wise. So for example, like traditional IPOs, they usually have like 6 months of vesting, yeah, just one thing to think about. In the crypto world, we have 4-year vesting or 1-year cliff plus 3-year vesting is like the gold standard. Some people want shorter vesting. But if you look at the cap table of a standard, crypto project, you'd probably realize like 50% or 60% or 40%, somewhere around there ends up being like half team, half investors. And so if you think about like a 2-year vesting structure, like that applies to the team as well. And so your team is like only incentivized to participate in this for 2 years now instead of 4 years. And your crypto network here inflates actually at like, 25-50% per year. Would you invest in a crypto network that invests 25-50% per year if you knew that? Maybe not. Maybe you'd trade unlocks. I don't know. And so I don't know. I feel like the industry kind of settled around this 4-year structure, but a lot of people don't realize that it's actually a lot more long-term focused than traditional IPO markets. VC funds in the real world, when there's an IPO, they usually just sell. And there's no commitment anymore. Like you go talk to the bankers now, like the Series B and C guys maybe, I don't know. But here in the crypto VC world, the VC firms have to be not only full stack, but also post-TGE partners, which isn't really a role that exists in the real startup world either. So just another thing to consider.
I mean, I would say that the difference here is that we're in quote unquote normal world. I love how you call it that. The VC, by the time you get to IPO, has been in there for like 12, 15 years, right? And so there's a pressure from the LP side of the world to create liquidity in order to recycle it back, right, into the firms themselves. And so it's an important mechanism. I think that needs to be available to us.
But in our case, in the crypto industry, the expectations of LPs of liquidity is slightly different than LPs in traditional funds. they want us to cycle pretty quickly.
Yeah, we
on
still,
that.
we tell them they have to wait 8 years, and 8 years is a reasonable estimate. Like 3-4 years to TGE, 4-year vesting. It's actually not too different from
It's
even
getting
traditional
close on
IPO
pair.
markets. Traditional IPO markets are also impatient with 12 years now. They're looking for 8 as well. We use the same docs as a traditional VC fund. So
And that's why secondaries are getting so big right now.
We're more likely to see Andreessen IPO itself than try to IPO $500 billion of target market cap they need to 3x their fund.
All right, back to Alex and Zurab.
Yeah, I think the vesting, and actually like using vesting in the crypto context for investors is probably not the right word, because they're more like lockups. Like, no one will take away your stake if you leave. So, but I think where this comes from, the 4 years, based on my experience, it's something that we borrowed or we inherited from traditional technology, like building technology companies, where you have 4 years, like actual vesting schedules, as a founder, or as a team member. So you go in and you know that you're locked in for 4 years. You get this stock options that vest over those 4 years, and if you leave, you basically give away the rest. Just as you said, if you decide to, go travel around the world, you probably should not get all of the benefit of all of the work that people do when they remain and build that project or company. So we kind of transitioned into crypto and loaned parts of different things from different parts, and we ended up with what we currently have right now, which is this hybrid model between sort of an IPO, a traditional technology building of a company, and also kind of expectations about liquidity. And then we're trying to fit everything in a way that kind of works for the team, works for the investor, and it works for the LPs. And we got what we got, but that's not a bad thing, because I think in crypto, we do things iteratively. So we try one thing, it works, great. If it doesn't, then we try another thing and another thing. So eventually we'll land somewhere that works. And I think this whole process, even this discussion, shows that there's no steady state position with regards to vesting. And it's also market dependent. 4 years might not look too bad in very bull market, but then when everything crashes and there's the abyss all around, even 2 years looks like a long time. So
yeah,
True.
Here's another thing that I think we're still missing is, though, on one side, I like the ability to claw back, so I like this idea that it's not actual vesting, right? But then we don't have the other side of the equation either. If you are an entrepreneur and you are really well performing and you just raise a bang around and you got diluted, your board will re-up you for a new grant that locks you up at that price for another 4 years. And so now you are incentivized to create that value, whether it be token or a share, over the next 4 years in order to unlock that. And so I would love to see that mechanism come to crypto.
Well, look at Aptos, if I may. Zurab, you?
Yeah, actually, I was just thinking, during those 10 years I've been in the crypto, I signed numbers of documents where vesting was from 6 months to 6 years. And basically, some of the best practices are usually lying somewhere in between. Are vesting needed or not? I think probably more yes than no, because it shows dedication from the VCs that they are focused on the long-term support in some way. And but same time, if vesting is extraordinarily long, it really creates lots of tension. It's actually quite bad. So some people may think it minimizes the supply, but the reality is different. So because the vesting is so long, when VCs are getting unlocked, they just dump it right away. It should be somewhere in difference, somewhere in between. And I guess there are also some pros on the vesting side. Some of the projects that have raised capital, they are successful. They do those OTC rounds where token is liquid, and very often they do OTC rounds with vesting. So in this particular case, they're large funds. Usually we personally participate mostly in seed and pre-seed, but there are large funds that are able to allocate, and they want to allocate larger capital, like some of the bigger funds, they do buy those assets if they have a dedication to it, and they get pretty good vesting schedule over like several years, and it reduces the supply and increases the confidence in the team, and gets more capital for them to develop.
The secondaries in a sort. Yeah, go ahead, Alex. You want to
I
add
think
something?
it reminds me of a very interesting point, which is while you're still being locked up and you're going through the vesting schedule, for some of the projects you can actually stake the locked up tokens and you get like liquid rewards. So
That's good. I was going to ask you to add like a short question in between. Disclaimer, I personally backed the project which is allowing to transfer on-chain and unvested tokens, but there's a resurgence right now of several projects that are offering that. So I wanted to ask your opinion. What do you think about allowing investors, whether it's VC or retail, to transfer their unlocked tokens on chain instead of using like 5 or 6 very famous OTCs we all know that are doing it in blind?
Yeah, so if the question is about selling softs or selling unvested tokens, I think the best way to go for it is to reach out teams, let them know that you need some liquidity, and obviously this is the best way to do it. Then you rather do it behind their back. I don't think those cases are really good and shows like you're a dedicated VC if you're selling something behind team's back. If you're dedicated, I think the best way to go for it, reach out to team. I have many cases where teams also reach out to us, guys. You were early investors. There is a demand, like some of the large funds, they want to buy back your shares. Would you be open? So this is probably the best way to do it. I try to avoid doing those transactions without letting teams know. This is like probably personal on my side, but also maybe I'm biased. I think this is the right way to do it.
Thank you. Anybody else? Rodney?
Yeah, I mean, you asked about like swapping like tokens between different holders, but like on chain.
On chain, so it's visible, so everybody knows.
I mean, conceptually it's interesting, but like 2 things I'd point out is like one, like token warrants just get represented as a contract until TGE, and then post TGE, like there's a contract, there's like a token, and it's programmable, and then you can trustlessly transact with that token. So if you're talking about like pre-liquidity share swaps or things like that, like it'd be very hard to trust people in an open source world. If you just upload a safe that looks like it's like the right Berachain safe, someone docu-signed it. I don't know the cap table or anything like that. So like there's a lot of issues there. Plus I don't know exactly what my counsel would think about this strange like open source safe. Like I don't have the other guy's KYC. I can't sue him if he doesn't give me my tokens, and I have no programmable rights. So there's a lot of issues that get opened up. I mean, post TGE, like there are like lockup platforms like ETHSign, which TGE'd on Binance yesterday. Those kinds of protocols I think are super popular these days among my portcos, or Magna, like you mentioned, or a few of these other tools where you can like lock up over a long period of time. I think a lot of them have considered launching like these lockup transfer systems, and I think generally they're great because liquidity for new strategics, or reduce sell pressure in the long run. New buyers come in at a higher entry. It happens in traditional markets all the time. Like secondaries in the real world are insane. Actually maybe more lucrative than primaries in the real world. People bought like SpaceX secondaries at 2 billion. It's at 50 now. It's great. Super liquid market. Doesn't really exist in crypto as much. Maybe behind closed doors, but same as for the real world as well. So.
I'll probably, not all liquidity is good. There is and this goes back to like normal finance, in every single shareholder agreements in the world, there's transfer rights and procedures about what happens when an existing shareholder, whether they are, currently or vesting or whatever it is, want to sell, right? And usually you go through the company and they have an opportunity to manage this. And so a lot of problems in our space is because we haven't yet invented a high quality mechanism on chain to govern these sales. Because when it happens really early in the company's life cycle, it's not particularly good for the project. I mean, we've done this kind of bizarre thing where we used to have kind of venture and private capital take execution risk. And then you have retail kind of looking at macro and market, right? You know, much later down the line. Great, we've completely inverted it. You can now capitalize an idea way ahead of it actually having any meaningful traction or really having anything at all. But that has other very bad effects. You need to create space for founders to be able to take their companies to market and to survive those storms. There is a reason why it takes years, you know, to build a company. And, you know, the 4 years, you know, and sometimes it's longer, right? You know, it didn't come from we want you around forever. It takes time to create a valuable enterprise. And it doesn't matter if it's crypto or not. You just need teams of people to ship software, convince other people to use it, and then sell them the stuff. The mechanism of how we actually fund these companies or how these companies transact between each other is completely irrelevant.
Thank you. Alex, want to add something, or you feel like enough has been said? Well, I was just going to say that the drama is here that we have volatility of these tokens that are locked, that I think is the issue. I mean, everybody understands that the company need to be built. Everybody understands the process. The problem is this very market.
I would say even in private markets though, like, you know, going back to the example of like the secondaries, like for SpaceX, they also have volatility in demand, you know. Pre-COVID, I think it was like 8, and then, you know, in COVID it was like 26, went to 40, went down to 20. There's all sorts of volatility, and that just comes from how much people want something, you know. Like somebody can say that there's a price, but the price is ultimately whatever people are willing to pay.
Demand and supply, they're saying.
Yeah, and whether or not that gets expressed in the UX, like it still exists.
I think
Right.
The big difference though is that Elon isn't losing any sleep if like 5 SPV slingers in the Palm are exchanging some 15 layered SPVs between each other, right? It doesn't change the nature of what SpaceX does. The danger in kind of our world is that, you know, this perception is reality of these projects, and if it goes sideways, again, the team, I feel, gets robbed of the air in the room to execute.
Yeah, you know, in some ways, but I would just say it's like, you know, transparency around the supply and demand. Like in private markets, we set these valuations, but you know, that's a snapshot of what the valuation was and what people are willing to pay. If the company runs out of cash, like it doesn't mean it's still a $22 million business. And if all of a sudden like ZK isn't popular because we invented like XK or whatever the fuck, you know, it's too bad, you know. Yeah.
Agreed. All right, so we're going to wrap it up soon. So one last big question. In the spirit of this debate on Twitter, in the spirit of the debate in the community of using VCs or doing a fair lunch, and in general, how we as VCs, and VCs that are present here today are all VCs that are adding value, but what kind of advice can we give to the VC community on how to add value and not to be vultures, so to speak? Can everyone share like their ideas on how we can add value?
I just think, you know, work closely with your portfolio companies, build a community of people who are excited to help new and upcoming technology. Yeah, and, you know, be there whether it's like hard times for the founder, exciting times for the founder. Yeah, maybe build a platform depending on what your unique value prop is, whether it's like hiring, BD, or, you know, like programming help or whatever it could be. But typically, I guess, VCs get known for different kinds of like strategic support over time. So.
Thank you.
Yeah, I think that's a very good question. Basically, my point is the following. So if you're in the space, in crypto space for more than 5 years, you kind of already have proved that you're a VC which provides value, not just providing capital. Otherwise, there is a ton of, you know, capital that can be allocated, but there's not enough smart capital there. Getting back to us, like I've been thinking like today, what were the cases where we showed some of the VCs some real value? Of course, we try to be supportive as we can, you know, with fundraise, with introductions, etc. But there is one particular case which I'm very proud of. There is a cross-chain bridge. Probably I will not show it here, but obviously maybe some of them know it. That they raised capital. We gave them grant on one of the hackathons. We invested right away, and during the first initial phase, they really struggled with liquidity. So they asked us to provide some liquidity. They were not that successful. They were not that public back then and vocal. And we did provide liquidity for 2 months. And then, time passed. We asked, is it fine if we withdraw? They asked to provide it for 3 more months because otherwise they could have not survived. So we just did it for the goodwill. We provided capital for 3 more months. And today company is very successful. They're generating lots of revenue. It's one of the best cross-chain bridges up to date, and I'm personally very proud. This is the probably the best answer to people who are asking what our VCs are actually doing. I don't want to say that every particular case is the same. Sometimes VCs also can be useless, but very often they do provide lots of value where it's needed based on the capacity and resources those particular VCs has. And also on top of that, there are several regions where those VCs have expertise and connections. I do recommend portfolio companies to have VCs which are from different regions so that they can get support from those regions as well.
Thank you. Gary, Alex, who goes first? Alex is ready.
Yeah, so I definitely agree. I think like VCs, the really solid ones, their value add shows up during like really tough times. So when you have really downtrend markets, when it's very hard to fundraise, very hard to show any growth metrics, that's the time to build, and that's the time actually to really partner and find out who is the best investor, but also advisor and mentor. During that time is actually like the opportune time to pick the best, the best partners for your cap table. I think in the bull market there's a lot of noise, and I think earlier in the panel someone mentioned about tourists. We actually have tourists on the team side, but also on the investor side as well. We had various attempts from more traditional like Web 2 investors trying to break into Web 3 with like very bad results, and I don't think that those type of investors are actually very well placed to help. However, you do have investors that have some very unique approach to whether that's geographical distribution or a specific technology they're very good at, or something else perhaps like they're very good at hiring and they can offer like marketing support and so on. So I think it's actually creating an ideal cap table for founders is a very important task, because then you can really get those VCs to work for you rather than the other way around. And actually it should be both ways, but a very solid roster of investors will get you a long way in terms of marketing, go-to-market strategy, some advice on maybe like tech or fundraising, whatever it is. Like it's important to try and use the network to the best of your ability.
Thank you. Sound advice, Gary?
I would say like you almost have to split it out into 3. If you are a multi-billion-dollar platform-oriented fund, you're probably doing everything. If you are a 1 or 2 man band, your job is to be a thought partner and to be there early, because otherwise you get crowded out. If you're a mid-sized firm, at least the path that we took is be amazing at 1 or 2 things that you can put a stake in, and excel at that. And that could be, hey, we have the absolute best on-chain research team. Hey, we have an army of lawyers who will speak to regulators for you because we can afford to bring those experts on board and to produce that work product. Hey, we have an army of salespeople. We are an amazing market maker. Whatever it is, it doesn't have to be all of it. If you're amazing at one, entrepreneurs will seek you out.
Good advice. All right, so I hope we gave you some good advice today on fair lunch, on investing, on, I don't know, shall I say soft trading on chain. Like talk to your VC, talk to your team, like try to do it in a transparent manner. That was the advice, right? Or what? Goes without saying, talk to your lawyer. I think the last one the advice that you have received here, I mean, my conclusion is that difficult time breed strong people. So we are going through difficult times and bear market, and I think this is a bit of a survival, and this is a bit of opportunity to build a bond between VCs and projects to weather this difficult market together, and I'm sure we all will make it. Vagmi. So thanks a lot to all our esteemed speakers. Thank you for coming. Selfie is a must, and then you're good to go.